Okay guys, hello! So in this video I'm gonna introduce you to the main purpose of the chapter 9 in the system book. The idea with this chapter is to know, of course, the profit and loss account, which is also called the income statement, but also the balance sheet. But we are going to take this knowledge into use in terms of using it for the knowledge of the bookkeeping. And bookkeeping is a way a company can understand and keep track of how much it's spending and how much it's making. The reason why companies tend to bookkeep is in order to decide which account a certain movement of payment has to be placed on. And to start off, the accounts are divided into two main groups, the profit and loss account and the balance sheet account. Each account is split into two sides, a debit side, which is on the left side, and a credit side, which is on the right side. Simplified setup we have here, where it says the year, the date, the receipt number, account name, description, page, which page is on whether it's in debit or in credit. And what we're going to talk about in this video is whether you place it in debit or whether you place it in credit, because it makes sense whether it's one thing or the other. As simplified, what is a debit sum? What is a credit sum? What is the balance of the account? Is it a debit balance or a credit balance? In this example, for example, if we start off with this, we see the debit account has 900 here, 600 there, and on the credit side it has 200. In this example, it has it's a debit balance, because we have 900 here, 600 here, and then 200 here. It means in debit balance we have 1500 here, 200 here, subtracting, that means 1300. The difference between the debit sum and the credit sum is the balance of the account. If the sum started under the debit is larger of the two, the balance is known as a debit balance. If the sum started under the credit is larger of the two, the balance is known as the credit balance. This would mean if this would be opposite, we would have a situation where it would be a credit sum and not a debit sum, which it is in this case. Increase the debit balance. If we wish to increase the debit balance by 300, we need to debit the account. This means that in this case, where we had 900, 600, and then we had a credit balance, we had 200, we increased by adding additionally, if you see here, additionally 300 to the debit balance. And this means that 900 plus 600, subtract 200, 1300, and add 300. That means that the new sum and new balance is 1600. Yes, it is. So that is excellent. If we see decrease the debit balance, if we wish to reduce the debit balance by 500, the amount must be credited, not debited as we did it previously. And here we see that we credit 500. What is the new balance? That means before we had 1600, now we subtract 500. Voila! We have 1100. Voila! Easy peasy. Yes, it doesn't have to be more complicated than that. Another example, in this case, 500, 800, and then 700. This has a credit balance. This means that 500, 800, and then we subtract 700. That means 500 plus 800. What is that? That is 1300. If we subtract 700 from 1300, what do we get? We get 600. Voila, voila, voila. Oh, increase credit balance. How do we do that? Increase, increase, increase. We try to do it like this. We say we increase by adding additionally 900 here under the credit side. Voila. This means that before we had 600, now we have 1500. decrease the credit balance, voila, then suddenly we put 500 under the debit side. That is crazy, because before we had 600, then we had 1500, then we attract 500. What do we get? 1,000. Voila, voila, voila. Excellent. It all made sense because we have a credit balance and we subtract by putting 500 under the debit side. Easy peasy. Basic rule of registration: account with the debit balance, increase the balance by debiting the account. It's the economy, stupid. It reduced the balance by crediting the account. It's the economy, stupid. Account with credit balance, increase the balance by crediting the account and reduce the balance by debiting the account. This is easy peasy. It should be understood by all of you. If you don't understand this within 2 weeks, you'll never gonna understand it. You probably should focus on strategy and something else in the course, because bookkeeping, but then you can be lucky because bookkeeping is no longer a part of the exam in a precise way. So you're not it's not something you're going to be asked about in that direct direction in the exam. Voila, this is the masterpiece. Annual accounts in the center. And then we have a profit and loss account, and we have a balance sheet. So if we look up here to the balance sheet, we see the debit, credit. Look over to the other side, all the way over there. Profit and loss account. Profit and loss account. If we're dealing with a cost, it has a debit balance. If we're dealing with an income, it has a credit balance. The balance sheet, if we are dealing with an asset, it has a debit balance. If we're dealing with a credit, it has dealing with liabilities, it has a credit balance. This is the essential part, and I'm gonna upload this slide, so it's there's no need not to understand it, but this is what you should use in order to understand these. Accounts and the basics pretty much sums up what I've just said in this one. Also here, increase, decrease the balance, also there. Double entry bookkeeping. This is the part where you need to understand. There's always two movements. Always a debit movement and always a credit movement. No matter what you do. If you sell something from a stock, you take it from the stock, you give it to the customer gives you money that you can put in the account. Always two movements, never just one. Everything is related in that. There are some examples that I'm going to talk about now. Example 1. A company purchases goods costing 6,000 and pays in cash by transferring funds from its bank account. Bank deposit account and stock account are affected. So stock and bank account. Which type of accounts are they? Cost, income, assets, liability. If we say the bank, we see the debit balance here and the credit balance here. Stock, debit balance, and the credit balance. So you take things from the stock. Does that make sense? And then take things from the credit side here in the bank. Company purchases in goods, so they purchase goods that they put on their stock. So their stock is debited with 6,000 and the bank account is credited with 6,000 because they take the money from the bank account. Example 2. Company sells goods costing 15,000, which is paid in cash. Sale of good account in cash and hands are affected. Which type of account are they? Sale of good. We see a company sells goods, so they credit the sales of goods because they take the goods from this account. And then they get cash in hand and they put that on another account, which they debit here. So it's the credit balance here and the debit balance here. Company deposits 8,000 In a bank account, this amount is taken from the cash in hand. The cash in hand account and the bank account are affected. Which type of account are they? Cash in hand, credit, you credit 8,000. Bank, you debit 8,000. Company pays rent 9,000 by transferring funds from its bank account. See the bank account here, you credit 9,000 because you take money from that. Cost of premises balance, you debit 9,000 here because that's transferred to this. Example number 5. This is the last example of this video and I hope you have enjoyed it. Company pays 12,000 for a portable computer transferring funds from its bank account. Bank account and fixtures and fittings account are affected. This type of account are they? You see fixtures and fittings, 12,000 added to this because of a portable computer. Bank account, you credit 12,000 because you have used 12,000. I hope you have enjoyed this video. I have certainly enjoyed making it. Hope you can use it and hope that it makes you a bit wiser on bookkeeping.